In this week's video, we'll review the latest charts and data to help us understand why the Fed's pivot opens the door to more upside in stocks. We'll be moving quickly, so feel free to use the pause button on your video player. As we move through a wide range of charts and data sets this week, we want to ask ourselves the following question. Does the evidence support an ongoing secular bull market or a period of secular stagnation and lower lows in stocks? Here are some of the major topics we'll be covering, starting with this week's Fed meeting. The Fed signaled to the markets using their economic projections that they were open to cutting interest rates 3 times in 2024, which tells us it's very possible, if not likely, that the Fed will shift from being a headwind for stocks in the economy to a tailwind for stocks in the economy. As always, we'll be using a weight of the evidence approach, and thus we'll be covering a lot of charts and data sets, and we'll be doing so very quickly. On each of the charts that follow, we'll be trying to address one particular question or make 1 or 2 points, and then we'll be moving on. We'll start with long-term momentum charts, and we'll ask, what do the following charts tell us about the market's appetite or lack thereof for risk? We've covered these charts numerous times, and they continue to be helpful. They speak to long-term market momentum, which is another way of saying long-term expectations about future economic and market outcomes. Typically, when the monthly Kopic curve drops below 0, bad things are happening. And when the monthly Kopic curve recaptures the 0 line, typically the major low is in the rearview mirror, and now you're in a period where good things are happening. 2023, right side of your screen, looks similar to 1982, 84, 88, 91, 03, and 09. Weight of the evidence approach. For the most part, everything that we said about the prior chart also applies to the Dow Jones Industrial Average, with a constructive look in 2023. The first chart was for the NASDAQ Composite. Same concepts apply for the more narrow NASDAQ 100. If we compare and contrast 2023 to the prior periods noted on your screen, does it look like the bearish phase? Or does it look like after the major low and after we've shifted into the bullish phase? There's a discernible difference between periods of secular stagnation and secular bull markets. During a secular bull market, the S&P 500 tends to make a stand at or near an upward sloping 200-week moving average in red. You can see it here, and you can see it here in 1994 and 1995. That is in stark contrast to what happens typically near the 200-week moving average during a period of secular stagnation. Chart on your screen, dated April 10th, 2023, was covered earlier this year on the final bar. And at that time, we said the market's momentum profile and price action near an upward sloping 200-week looked like an ongoing secular trend. That was the case in April. And that's also the case on December 14th, 2023. This really doesn't look anything like this, nor this. From an intermediate term perspective, during the recent correction on October 31st, 2023, we noted that the longer term outlook still looked constructive and that we should be keeping an open mind about better than expected outcomes after the correction. On October 31st, 2023, we had a constructive look here, similar to this look here and this look here. And the look on October 31st, 2023 really didn't look anything like this concerning look in 2001, nor this concerning look in 08. If we fast forward to December 14th, 2023, upper right-hand corner of your screen, price above the cloud, blue above red, and the green span above price. From an evidence perspective, that looks a lot like these periods during the secular trend from 1950 to 1968, and very similar to these bullish crosses between 1982 and the year 2000. The November 3rd video, we used this chart to make a case that 2023 still looked like an existing ongoing and healthy secular trend, and that the weakness that we had experienced and could see on the chart on November 2nd didn't look materially different from 58, 63, 67, 78, 82, 88, or 2016. You can see in each of these cases, the 10-month moving average in blue comes back and kisses an upward sloping 40-month moving average in red. If we zoom in on the same chart on December 14th, blue coming back, kissing an upward sloping 40-month in red. How is it possible that good things could continue to happen similar to this window here from 1988 into the year 2000? As we noted last week, we can make a factual argument that the present-day window, 2022 to 2027, is very, very similar to the 1988 to 1994 window. And this look here, and this look here on December 14th, align with rather than contradict all the information you can find on our website by Googling the title on your screen. Look constructive on April 10th, looks constructive on December 14th, and thus it still aligns with the concept that if we're able to tolerate volatility and take a big step back relative to following trends, good things could continue to happen for a long period of time. If you polled your typical market participant, it's not likely that they're well versed in how a recession is determined in the United States. And given that we see countless data sets that are presented telling us that we're about to enter a recession, most may not know that there's really only 6 major data sets that are used to determine whether the U.S. economy is expanding or contracting. And the big 2 out of the big 6, real personal income less transfers, and non-farm payroll employment. And while there's a never-ending attempt to forecast and a never-ending call for an imminent recession in the markets, common sense tells us why personal income and payroll data is important. If people aren't losing their jobs, and they're not afraid of losing their jobs, it's highly unlikely that they're going to significantly curtail their spending. So what does the National Bureau of Economic Research typically see when they call a recession? Shaded areas, recessions. 1973-74 bear market, real personal income, excluding current transfer receipts, clearly in a downtrend. Clear deterioration, weakness and deterioration. Not difficult to see the trend, easy to spot from across the room. And when the trend in income goes from point A to point B, it's easy to understand why people would curtail their spending and why the economy would begin to contract. How does the exact same data set look today? The facts that we have in hand today. Do we have major problems with personal income? We do not. This data was pulled off of Fred this week. Real personal income, excluding transfer receipts, just made a new all-time high in 2023. This really doesn't look anything like this. And yes, you can make the argument that this can change very, very quickly. That's true with credit spreads as well. Could have made the same argument 3 days ago, 3 months ago, 13 months ago, 26 months ago. And thus, until we start to see some significant deterioration in the data, the past 24 months have told us it's probably more important just to pay attention to the data set in front of us. How about non-farm payroll employment? 1945 recession, based on this trend going back to 1943, it's easy to understand why we entered a recession. Same can be said here, here, and here. Weakness in both windows, weakness in the double dip windows. Not difficult to see that people were losing their jobs in the 1990-91 recession, 2001 recession, and the steep and difficult to miss trend in 2007 to 2009. How's the present day look? Better, worse, or about the same? If we look at the 1-year trend, pretty easy to say better. Total non-farm payrolls just hit a new all-time high. Reuters, December 14th, 2023, retail sales rebound weekly jobless claims fall. This concept applied every single month over the past 24 months. Not making any assumptions about what this data set's going to look like next month, or in 3 months, or in 6 months. We'll continue to take it day by day, week by week, and month by month. Nothing here, nor here, that says we have a problem on this front, or even really should be particularly concerned about an imminent problem on this front. And if we look at all 6 data sets as of December 14th, nothing here screaming imminent recession. That was true 6 weeks ago, 6 months ago, 9 months ago, and 18 months ago. About market breadth. Peaks in Q4 of 2021, subtle and observable shift, December 13th, 2023. We've showed this chart a handful of times in this green window here. Signal fired numerous times. Really doesn't look anything like this window in the year 2000. Doesn't look anything like the window in the financial crisis. And it's significantly improved relative to early in 2022. Showed the large chart on your screen earlier. So look of this breadth indicator here on November 9th, and we said it needed to improve. It has improved. Another form of evidence relative to the rally trying to broaden out, the multi-sector Dow Jones Composite Average made a stand recently at an upward sloping 200-week moving average in red. NYSE Weekly, a very concerning look on November 1st here. It turned out to be a false alarm, a false breakdown with a sharp reversal, and then a high above this high. That is typically a good sign, a bullish sign. Similar message here on the weekly cloud chart. Not a good look just a few short weeks ago, a much improved look on December 14th. The concept of an abrupt and sharp reversal aligns nicely with the concept and need to maintain maximum flexibility. How rare is a move this fast and furious conceptually? In the case of the Russell 2000 index, the shortest turnaround time in the index history to go from a 52-week low to a 52-week high, dating back to the 1970s. Covered this chart numerous times, and numerous times we've said it needs to improve, including this look here presented in a November video. This is the look here on November 1st, just a few short weeks ago. We've been saying over and over and over again we'd like to see this improve, and today it has shown significant improvement. This level here, if we go back and we look at the dot-com bust bear market, we failed here at the dotted blue line. We failed here at the dotted blue line, and the bear market resumed in a painful manner. Not the case here after the major low that occurred in October of 2002, and not the case here after the major low that occurred on March 9th of 2009. In this case, the stock market rallied for several more years. In this case, the stock market rallied for several more years, simply telling us to keep an open mind about better than expected outcomes from a very long-term perspective. It's probably fair to say that this, and this align nicely with all of this and the concepts covered on June 16, 2023 that you can find by Googling the title on your screen. This ratio also speaks to a subtle shift in market breadth. This look here, similar to this look here in this window, and similar to this look here, both in risk-on periods for the S&P 500. Global stocks up here November 1st, testing an upward sloping 200-week moving average in red. It appears that that test has passed with flying colors. We held at the upward sloping 200-week in red, and we've gone on in short order and exceeded the high from July of this year. During a secular trend, markets tend to make a stand at or near an upward sloping 200-week moving average, which is exactly what we have on the chart of VT Weekly, the Vanguard Total World Stock ETF. How about the credit markets? Do they align with a deep recession or crisis? Or do they align with a market that appears to be becoming much less fearful about imminent and broad bond defaults? Dow Jones Corporate Bond Index here breaking out of a very long-term, multi-month consolidation box, small chart dated December 13th, large chart dated December 13th. Credit markets constructive here during the bottoming process in 08-09. The same index turned up here in 2002, very, very close to the October low in 2002 in the S&P 500 index. Chart on your screen dated December 12th before the Fed meeting, financial sector, S&P 500 financial sector, still making a stand at this level here dating back to the financial crisis. After the Fed meeting, we exceeded this high. Right now, it looks like we have a bullish breakout in a very important sector, and this also speaks to improving market breadth. Showed this chart several weeks ago, and thus far, potential resistance is acting as resistance, at least in the short run. Highlighted this chart here on October 31st when things weren't going particularly well for the risk-on trade. It's the same chart after a significant bounce in a very relevant area. Seen a big reversal in risk assets, and we've seen a big reversal in interest rates. This is what JNK looks like here during the financial crisis, when market participants are concerned about increasing bond defaults. Similar situation here, 2015, early 2016, when the market is concerned about increasing bond defaults. Conversely, this is increasing confidence after the major low. The present day looks a lot like the increasing confidence periods. It really doesn't look anything like the concerning period that we had in 2022. Exact same concepts here. We're using the Vanguard High Yield Corporate Bond Fund as a proxy for JNK. Holds near the 50-month, good things happen in the stock market. Recaptures the 50-month, 50-month turns up, good things happen in the stock market. Similar situation here, 2016. COVID low and at the October low last year, but we still need to recapture and move away from that 50-month, and we are improving on that front in December. Chart that we've shown on Twitter several times, including in October, and thus far, at least from a counter trend move or bounce perspective, TLT long-term treasuries, the ETF has responded. Only two times in this chart where BIL divided by XLK dropped below a green cloud. After the major low in 2009, earlier in 2023. S&P 500 bottoms Christmas Eve 2018. Down here, the True Strength Index for the ratio of leveraged loans, BKLN, divided by VU. Weekly TSI drops below zero after the low in the stock market. Weekly TSI drops below zero after the major COVID low in the stock market. Weekly TSI drops below zero earlier in 2023. Once again today with a risk-on look with TSI for the ratio dropping below zero on December 13th, 2023. In each case, the ratio went up to a downward sloping 200-week and reversed. We enter the land of confusion in April of 2022, and we have an indecisive market, and this indecisiveness speaks to indecisiveness relative to interest rates, Fed policy, and inflation. Failed breakout here in early 2023. Failed breakout in July of this year. November, December 2023, starting to look like a successful and confident breakout. This speaks to this and this. Always have to ask ourselves, what does a chart, move in the market, or ratio tell us about market participants and their expectations about future economic and market outcomes? High-yield bonds relative to more conservative 3 to 7 year treasuries. If you believed a massive recession was imminent and bond defaults were going to skyrocket, it's not likely that you would move and prefer to be in the riskiest end of the bond market relative to the more conservative end of the bond market, backed by the full faith and credit of the U.S. government. Said another way, this is a risk-on breakout until proven otherwise. Talked about the potential bullish implications, chart on your screen, for a long time now, including in August of this year via this tweet. A failed bullish breakout look here and a very concerning bearish breakdown look in October of this year, and then that sharp, confident reversal that we have today. This really doesn't look anything like all of this dating back to the land of confusion in April of 2022. Everything that we said about this ratio and what it tells us about perceptions of risk and future economic and market outcomes and default probabilities, it applies to IGIB intermediate term corporate bonds relative to IEF. This is a risk-on look here. This is a risk-off look during the COVID plunge. Similar concepts here, above and upward sloping 200-week moving average. We covered the potential bullish divergence in LQD corporate bonds in October of this year. Here's price in late October, heading into early November with that divergence. Credit markets have responded December 13th, LQD trying to break out from a multi-month period of consolidation, and it too entered the land of confusion in April of 2022. Covered this chart many times. LQD, riskier bonds relative to more conservative U.S. Treasury bonds. This is what risk-off looks like during the financial crisis. This is what December 13th, 2023 looks like. All of these charts speak to the perception of credit risk, credit defaults. Short-term high-yield bonds are a higher-yielding instrument relative to more conservative BIL. This is what increasing economic fear looks like in Q1 of 2022. This is what increasing economic confidence looks like in late 2023. When things weren't going particularly well in the stock market, we showed this chart here on November 9th and said this look here says we should try to be patient, take a measured approach with risk management. It's probably fair to say that this window in here from Q4 of 2021 into the October low 2022, the red box looks discernibly different relative to the blue box. And now we've broken above the blue box and the red box and exceeded this high that was made in September of 2021. Covered this chart, dated October 11th, 2023, several weeks ago. It's the fan principle, and it leaned bullish from a longer-term perspective. Now this looks like a bullish breakout in May of this year, a scary retest that here looks like a failed breakout, and this is legitimately concerning just a few short weeks ago, and then we get that sharp and confident bullish reversal. Now we have what looks like a bullish breakout above this level here from 2022, a successful but scary retest, and a higher high. S&P 500 relative to bonds. This segment is about market breadth. It also applies to the broad S&P 1500 relative to bonds. The Schwab Broad Market ETF, SCHB, relative to 3 to 7 year treasuries. The concepts on these charts, similar to the fact that credit spreads were relatively tame, as noted in this October 31st tweet when the market was extremely weak earlier this year. This key risk-on, risk-off area did hold, and here's a look at the same chart this week in mid-December. And all of these charts help us address this question. Continuing with the weight of the evidence approach, this was the try to be patient, try to be measured with risk management look that we covered in October of this year and in early November. We still have the constructive look on December 14th. The chart that we covered earlier in November, and we said from a risk-on perspective, we'd really like to see RSI for the NASDAQ move to a look more like the blue box. If we look at the same chart on December 14th, started to improve considerably in early to mid-November. Concerning December 12th, much improved. Failure in 02, momentum failure in 08, successful push above and retest in 2023. If you compare the look in the present day, this looks like periods after major lows. The slowing momentum and deteriorating look for the CRB index, physical commodities, speaks to inflation expectations. Dow Jones Consumer Services Index, this really doesn't look anything like this failure in 2008. If we zoom in on this look here, we have a nice constructive breakout after a scary failed breakdown earlier this year. Covered this chart in detail numerous times, including in January of this year. The chart on your screen is dated January 26th, and it's from a previous video. The basic takeaway was this was a constructive setup here. If we fast forward, the economically sensitive, interest rate sensitive, and inflation sensitive Dow Jones Home Construction Index has taken advantage of the favorable setup that we had in Q1 of this year. This really didn't look anything like any of this. This is pre-Fed, December 12th. It looks even better after the Fed. This doesn't really look anything like this concerning turn here in 2022. This really doesn't look anything like holding near the zero line in 2023. Constructive look 2004, constructive look 2009, similar look in 2023. 30, 40, 50 week, this is a strong trend look here. This looks like a counter trend move within the context of an existing uptrend, and this looks like a reestablishment of that uptrend. November 10th, here we said, yes, it looks vulnerable. Yes, it looks like weakening momentum, but for the most part, we're still checking a lot of bullish boxes here, and we look even better on December 12th. Can't clear it momentum-wise in 02, can't clear it in 08, did clear it after the major low in 2016. This looks a lot more like the bullish periods relative to this in 08 and this during the dot-com bust bear market. If you look at this box right here, this is a constructive entry point here, and the same can be said for the present day in 2023. Concerning a few short weeks ago, absolutely positively yes. A lot better today? Absolutely positively yes. You can pause your video player here. Physical gold relative to the S&P 500. Good things happen here in the stock market walking forward. Good things happen in the stock market walking forward. Similar period here. This is telling you that stocks look better than gold. Having said that, gold in isolation still looks pretty constructive. Here's your cup, here's your handle. This is November 30th up here. This is what increasing concerns about the Fed, interest rates, and inflation in the economy look like. You can make an argument that this is the polar opposite of this breakdown here relative to this breakout here. Failed at this level during a rally attempt in 2001 and then went much lower. What once acted as resistance may now act as support. During secular bull markets, markets and ratios tend to make a stand at or near an upward sloping 200-week moving average. The same can be said for the sister, the 50-month moving average in blue. Left shoulder, head, right shoulder. Left shoulder, head. Can make an argument, right shoulder. Risk on look in 2016, S&P. Risk on look after the COVID low, S&P. Similar look on December 13th. What once acted as resistance, may now act as support. Referenced this chart, this ratio, May 7th, and said this is a good look. It looks different relative to what we've seen in the rearview mirror. If we look at the same chart on December 13th, looks like a bullish breakout, consolidation, and another push higher. XLK relative to the S&P 500 monthly. Can make an argument that we're artificially pushed above an upward sloping 50-month by the massive amount of money printing and stimulus around the globe. Trend needed to calm down a little bit, came back, mean reversion here to that upward sloping 50-month, and has gone on to print a higher high. It's possible after this move here on a relative basis that XLK needs to have a little bit of a counter trend move within the context of an existing uptrend, but that's for the market to decide. Looks like a counter-trend move within the context of an existing uptrend making a stand above the zero line. Bullish trends tend to make a stand at or near an upward sloping 200-week / upward sloping 50-month. After the major low in 2003, after the major low in 2009, after the major low in 2016, a very similar look in 2023. Covered this chart in early November. It told us to keep an open mind about better than expected outcomes. This in 2008 really doesn't look anything like this in 2023. This in 2007 really doesn't look anything like 2023, and still supports the concept of a demographically driven secular bull market that could last until 2035. And during the trading session on Friday, December 15th, the scores from the CCM secular volatility model also firmly align with the secular trend thesis, simply telling us to keep an open mind about much better than expected outcomes over the next 1 to 12 years. And Kathy and I wanted to take a moment to tell our clients how much we value and appreciate their business in 2023, and we hope all of you have a safe and relaxing holiday season. And as we covered in detail in last week's video, which you can find by Googling the title on your screen, we've been operating in a significantly different environment over the last 2 calendar years, and most likely many of those same and different characteristics will be with us in subsequent years. And thus, if we're willing to adapt and make the necessary adjustments to our approach, based on the facts that we have in front of us today, the opportunity in the stock market over the next 10 to 12 years is most likely much better than most believe or expect. And as always, the commentary and probabilities discussed in this week's video are based on the facts in front of us today. If the facts change, we have to be willing to reassess those odds if needed. And we all know the only way that we can do that effectively is we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.